And there you have it, the closing bell at the New York Stock Exchange, capping off another day of trading on Wall Street, a day closely watched after the Dow fell more than 1,000 points on Friday. The Dow Jones today closed down more than 180 points. The S&P fell by about half a percentage point, while the Nasdaq is down by around 1%. Investors are still digesting Federal Reserve Chair Jerome Powell's comments last week that more interest rate hikes are on the way. The Dow fell 1,000 points Friday, as we mentioned earlier, after he made those remarks. So let's bring in Joe Saluzzi now. He's partner and co-founder at Themis Trading. Joe, welcome. Great to have you with us. So sometimes after a big sell-off, there is somewhat of a rebound in the markets. Why do you think that didn't happen today?
Yeah, I think, it was Friday was a bad day, right? So there's no question. In fact, I'm looking at today's numbers and saying it's not that bad. This could have been worse. We were opening, this morning, it was looking actually worse on the futures. But I think the news that Chair Powell said on Friday was certainly concerning to some investors who were hoping that maybe next year they would actually start decreasing interest rates. And that's where the market got ahead of itself. They were, pricing in current, this year's interest rate hikes. And then they were thinking, okay, maybe we'll go backwards. But what Chairman Powell said last week was that we're not going to stop. We're going to keep at it. We want to make sure that inflation doesn't look like it did back in the 1970s and the 1980s when the Fed kind of eased off the gas pedal a little bit. So they're going to keep at it, which I think in the long run is a better strategy than going back and forth. So there will be some short-term pain, even as Chair Powell said on Friday, but this could be better for us in the longer term.
All right, so you just answered my next question, because that's what I was going to say. He did warn, Jerome Powell did warn that this was going to bring some economic pain to families, raising interest rates, but he pointed out that failing to bring down inflation would be far worse. And so you're in agreement of, on that strategy then?
Absolutely. I mean, inflation is the worst thing that could happen to markets. And it's spiked up so quickly. We're up to over 9% just last month, 2 months ago. So you need to get that under control. And I think the problem here is that the Fed started too late. They've kind of let this fester throughout, and they could have had a quicker start. But either way, they're doing it now. They're involved. I'm actually happy to see that they're not going to back off and say, okay, the market wants us to, ease off. The market had a nice run. We had a 15% rally from the mid-June lows to just a couple of weeks ago. Now we've given some of that back, but I think overall, that's not a bad thing. What the chair is also going to look at now is unemployment numbers, other factors that they look at, some of the CPI index, which are coming out soon.
Right.
So more data. And they've always said they're going to be data dependent.
Yeah, so I'm curious, if this is the right move by the Fed, why did the markets react so negatively?
They had priced in, basically the market thinks they're always smarter than everybody else, right? And they priced in the fact that the Fed could potentially decrease rates next year. We're always looking forward. We don't care about yesterday or tomorrow. The market's always looking 6 months ahead, a year ahead. And they were thinking, and the consensus was that we might get some interest rate cuts. Well, he said, no way, that's not going to happen. So I think now everybody's kind of readjusting those expectations.
And so, Joe, as you mentioned, the August jobs report is coming out Friday. If the Fed does move forward with another interest rate hike, which it appears almost positive that it will, how do you think that's going to impact the job market?
Right now, the estimate for Friday, I'm looking here, is 3.5% unemployment with an increase of 300,000 jobs. That's actually would be a really good report if we get it. Overall, I think as you continue to increase rates, corporations will start to cut a little bit more. Earnings will get hit, so they will cut cost at that point, and it will tighten up the job market. But you're looking at a 3.5% unemployment number right now, which is a very good job market. So if it tightens a little, well, that might be part of the pain, I think, that Chairman Powell was talking about last week.
All right. Well, Joe Saluzzi of Themis Trading, thanks so much for sharing your insight with us. We appreciate it.
Thank you.